Welcome to The Explainer. I am absolutely thrilled to have you here today because we're tackling one of the most fascinating exercises in all of finance, finding the actual truth hidden inside the numbers. Today, we're taking the raw, unfiltered financial data for Intercontinental Exchange. You probably know it by its ticker ICE. And we're going to build what I like to call a valuation pyramid. We're going to stack layer upon layer of data to cut right through the market noise and uncover this stock's true underlying health. We aren't just looking at a stock price today, we are reverse engineering a financial engine. Let's get into it.
Okay, let's dive into this. Here is our roadmap for today. We'll cover 1. The IC performance overview, 2. Profitability and growth, 3. The valuation multiples, 4. Intrinsic value and safety, and finally 5. Dividends and yield.
Section 1. ICE Performance Overview, the long versus short term.
Before we figure out where a stock is going, we have to understand where it's been. And with IC, we're really looking at a masterclass in market psychology. Zoom out to the last 10 years, and this stock has been an absolute compounding machine, delivering a staggering 1,617% return. I mean, wow. Even over the last 5 years, it's up a very solid 46%. But notice the recent shift. Year to date, the stock is down over 4%. And in just the last 30 days, it's slumped about 6.5%. So the big question is this short-term dip a red flag, or is it a rare, discounted entry point? Well, to answer that, we have to look under the hood at the actual business.
Section 2. Profitability and growth, the business engine.
Let's move to the business side and see how this builds. If the stock price is slumping, we need to know if the underlying business is sputtering out, right? Well, the data shows the exact opposite. Just look at this cascading growth. Over the last 3 years, ICE has grown its top-line revenue at a really healthy 10.65% annually. But because this business is highly scalable, that 10% revenue growth literally cascades into a massive 39.59% growth in net income. And it gets even better. Over the trailing 12 months, earnings per share has exploded by nearly 80%. So the stock price might be down, but make no mistake, the profit engine is roaring.
Now, what's absolutely crucial to understand here is that the secret to that cascading growth is extreme efficiency. ICE boasts a net profit margin of nearly 26%. Think about what that means in the real world. For every single dollar that comes through ICE's doors, after paying for absolutely everything, salaries, tech, taxes, debt interest, the whole shebang, over a quarter of that dollar flows straight to the bottom line as pure profit. That is an incredibly wide moat.
And they aren't achieving these margins by taking on reckless risks either. Their balance sheet is rock solid. A current ratio of 1.01 means they have exactly enough liquid assets on hand to cover all their short-term liabilities over the next year. And their debt-to-equity ratio sits at a very manageable 0.69. So the financial foundation is secure, the margins are huge, and the earnings are compounding rapidly. Which brings us back to the million-dollar question. Why is the stock down?
Section 3. The valuation multiples, pricing the market.
We know the business itself is thriving, so how is the market actually pricing that growth today? Well, this brilliantly illustrates a massive disconnect between today's price and recent history. Currently, IC trades at a price-to-earnings ratio of about 22.5, but its 3-year historical average, that's 32. It's trading at a price-to-sales of 6.69, down from an average of over 7.4. Across the board, whether you measure by earnings, sales, or book value, the market is currently offering IC at a significant discount to its own historical baseline. We can actually take this a step further using the PEG ratio, a metric famously popularized by the legendary Peter Lynch. You see, this standard PE ratio is great, but it has a blind spot. It doesn't account for how fast a company is growing. The PEG ratio fixes this. It divides the PE ratio by the company's earnings growth rate, essentially asking, how much am I paying for each unit of future growth? And for ICE, the PEG ratio sits at an astonishing 0.53. In the world of traditional valuation, a PEG ratio of exactly 1.0 means a stock is perfectly fairly valued. Anything below 1.0 is considered a highly attractive entry point, meaning you're paying a very low price relative to the massive earnings growth we saw earlier. At 0.53, the market is severely underpricing IC's growth engine.
Section 4. Intrinsic value and safety. What is it worth?
Okay, multiples are great, but they're relative. Now, we're going to strip away all that market sentiment and use a discounted cash flow model to see what the actual cash generation says this business is worth. The market recently closed with ICE priced at roughly $154.36 a share.
That is Mr. Market's price tag. But when we mathematically project future free cash flows, what is the actual fair value price?
It's $259.42. Just let that sink in for a second. The data models suggest that based on the actual cold, hard cash this business produces, a fair price to pay is nearly $260 a share. Yet you can literally log into your brokerage today and buy it for $154.
So, the crucial point here is that this gap provides a massive 40.50% margin of safety. Warren Buffett 101, right? It means the intrinsic value of the company could drop by nearly half, and you still wouldn't be overpaying at today's price. It provides a huge cushion against economic shocks, keeping your downside highly protected while the upside remains incredibly compelling. Section 5. Dividends and yield. Shareholder rewards.
Now, a 40% margin of safety is fantastic, but we all know sometimes it takes the market years to realize a mistake. So, do you get paid to wait? The short answer is yes. Notice the progression of the dividend yield. The trailing 12-month average yield was 1.19%. The 3-year average sits at 1.24%, but the current yield right now has pushed up to 1.35%. Because the stock price has dipped in the short term, the yield is actively trending upward. It's not a massive, flashy yield, sure, but it is incredibly stable and moving exactly in the right direction for new buyers.
And more importantly, that dividend is extremely well protected. IC has a payout ratio of just 28.9%. This means they're using less than a third of their profits to pay that dividend, retaining over 70% of their cash to reinvest back into the business, pay down debt, or acquire new assets. The dividend isn't starving the growth engine, it's just a healthy byproduct of it. Because they manage their cash so well, management has been able to deliver 13 consecutive yearly dividend increases through bull markets, bear markets, inflation spikes, and global pandemics. For over a decade straight, IC has consistently given their shareholders a raise every single year. That is the ultimate proof of management's confidence in their cash flow. Well, we've built our pyramid. We've seen the 10-year compounding history juxtaposed against a short-term dip. We've seen the cascading profit growth, the historically low valuation multiples, that massive 40.5% margin of safety, and a growing dividend to pay you while you wait. So I want to leave you with this provocative thought. With all this underlying strength hiding in the data, is IC's current price slump actually a warning sign? Or is it a rare, wide-open window of opportunity for the patient investor? Thank you so much for joining me on this explainer. I highly encourage you to apply this structured, layer-by-layer framework to your own research. Until next time, keep digging into the numbers.